What's up everyone, it's Kadi with MoneyVest. So in this video, we are going to be talking about Walgreens, which is absolutely taking a beating right now. It's getting crushed at the moment as it's down a little bit over 24% selling off after the earnings. So hope you all enjoy this video and a quick update on this company. It's been a while and we're going to be using our very own MoneyVest platform to basically go over the entire stock. So again, hope you all enjoy it. Find it helpful, make sure that you drop a like, and of course, don't forget to subscribe to the channel if you're just joining us for the first time, and link to our Discord and Patreon is going to be down below. I do want to mention that I posted a brand new video for everyone introducing the MoneyVest platform. So there we go, 8 hours ago, I posted this. This is a public video, by the way. This is on Patreon. You can watch this. This is at no cost, for free. Everyone can watch this. It's a 22-minute tutorial going over, giving you guys a little bit of a taste of what the MoneyVest platform is going to look like. We analyze Microsoft in this video, going over everything related to the company. And again, there's a lot of people excited about the overall launch. And again, link's going to be down below if you want to join. Currently, we do have a pretty big discount, so over 51% discount right now for the beta launch with limited spots left, and you'll be locked at this price, and all the additional features and tools and functionality that we're going to be building, you will be pretty chill because of the no additional increases in prices. So you'll be locked at that price and you'll be able to access everything starting July 8th. So coming over to Walgreens, obviously not having the best of days. So Walgreens stock plunges as drugstore chain slashes profit guidance in challenging consumer environment. So I actually exited out of my position. I sent out the alert on Discord, finally decided to take the L and close out my position. Now, I did receive a lot of dividends over the last 2 years, so that kind of salvaged some of that damage. But yes, I did take a reasonable hit on the overall position. So that's a loss that I did have to realize. Being completely transparent and honest here, if you come down to the actual numbers, so retail pharmacy giant now expects fiscal 24 adjusted earnings of $2.80 to $2.95 per share, and that compares to the company's previous outlook between $3.20 and $3.35. So definitely seeing a significant revision to the downside. We assumed in the second half that the consumer would get somewhat stronger, but that is not the case, is what Walgreens CEO Tim Wentworth also told CNBC. He added that the consumer is absolutely stunned by the absolute prices of things, and the fact that some of them may not be inflating doesn't actually change their resistance to the current pricing. Still, Walgreens topped revenue estimates for the quarter on strong performance. 75% of our stores drive 100% of our profitability today, and what that means is that the others we take a hard look at, and we were going to finalize a number that we will close. So they are going to be closing some stores here in the US. Earnings per share coming in at 63 cents per share versus 68 cents expected, and revenue coming in $36.4 billion versus just shy of $36 billion for the revenue here. And they book sales of $36.4 billion, up about 2.6% for the quarter compared to same time last year. And the company reported a net income of $344 million or 40 cents per share for the quarter. That compares with a net income of about $118 million or 14 cents per share for the same period, same time last year as well. And did not provide a new revenue forecast for the year, but the company has not offered any guidance since October, when it said that it expected about $141 to $145 billion in sales for the company. So this right here, again, analysts were expecting 71 cents, so company reported 63 cents, down about $1 from same time last year. So this is basically slashing outlook, also suggesting for some cut down in the overall stores. And as a result, the stock is down over 24, almost 25% here on the day. Looks like it is halted. No, it's not. Selling off quite aggressively, down almost 25%, trading now under $12 a share, with the dividend yield is obviously going to be much higher once adjusted. And this stock, of course, has performed really poorly. I mean, it's been selling off. It's just been a falling knife, not able to catch any breaks, and it's since 2015, where it marked a peak in July of 2015. So exactly about 9 years ago, July 27th. It's actually quite crazy that today is June 27th, so just a little bit over 9 years ago, it marked a top at around $70 a share, and since then it is down over 83% from its all-time high. So definitely selling off quite aggressively here on the day, and of course overall as well. So coming over to Walgreens, if you come over to the M score, 2.68, and unfortunately, it actually scores pretty poorly across the board on a lot of other metrics. So the beauty of this platform is that you can very quickly analyze some of the most important metrics for any company, and it's broken down into 5 different categories. We've got growth over here. We got profitability, then we got efficiency, then we've also got financials, and then finally we've got the valuation for every company as well. And again, you can plot and visualize whatever it is that you want to do, right? Whatever you want to do with this data, with this metric. So for example, over the last 5 years, revenue has only increased by 1.12%. It's gone from 136, almost 137 billion to 139 billion. It's been more or less stable. You can plot these numbers over here. Again, you can take a look. Pretty much moving sideways. Declining gross profit, declining operating income, in fact, rapidly declining. It's gone from 5.7 to just over $3 billion in 2023. Net income has gone from $4 billion to a net loss of $3 billion. EBITDA has gone from 7.7 billion to 5.4. So again, also declining operating income, operating cash flow and free cash flow also declining rapidly here. And even though share buyback has been pretty strong at 924 million, coming down to 863 million, about 2.8% share buyback, everything else is just coming down. So this is unfortunately very much of a dying company, as it seems like. If you come over to the last 10 years as well, or 7 years rather, you'll notice again, very, very similar trend of revenues coming down. Profitability, of course, taking a hit in 2023. It was profitable prior to that, with a little bit of consolidation, of course, especially in 2020, coming down to $456 million in net income. And then, of course, generating a net loss. And this right here, free cash flow, 142 million. The year prior, 2.1 billion. So it's been very, very stable and not so growing business for Walgreens. If you come down across the board, we've got a 1.33 out of 5. Everything else coming down. Margins are not doing well. Gross margins, operating margins, net margins, you can take a look. Again, they've all been declining. Gross margins highs of 24, 25% back in 2017. Now down to under 20%. Then we got operating margins, well over 5.6, coming down to now under 3%. And net income margins going from 3.5% to, of course, now generating losses, negative 2.2%. So worsening or compressing across the board for this company. Efficiency-wise, it's mostly stable to somewhat highly efficient when it comes to operating leverage. The company has little to no operating leverage. And we do have a lot of stock-based compensation, 43% as a percentage of free cash flow for the company. In fact, it has increased significantly in 2022. I mean, 18% to spiking up to 271%. That's probably because free cash flows obviously did decline quite a bit. So free cash flows were significantly down in 2023, $142 million. So as a percentage of free cash flow, obviously that number did spike quite aggressively. And free cash flows, for that matter, have declined by 42% in the last 7 years. So it's a huge decline in the company in terms of free cash flow. When it comes to financial table, so they do have a lot of debt compared to the cash. So they are sitting on well over $10 billion of debt versus cash of 4.2 as of 2023, by the way. So not as of this quarter. We'll take a look at that in just a minute. And then, of course, if you come down further, we've got some other things also not super great. Debt has decreased, but the cash has worsened at a much faster rate. And everything else is, bad to very bad. The only excellent things are total assets over total debt. So the company does still have, more assets compared to total debt. However, I will point out that the company does have a lot of goodwill as well. So that, again, is the last row. As you can see, that it says very bad because the goodwill as a percentage of total assets is very, very high for the company. So you'll notice that it's well over 43%. It did decline back in 2020, 2021, came down to around 27.5%, and of course increased higher at 43% as a percentage of total assets. And finally, when it comes to valuation, so we can't really calculate the price to earnings, but price to sale is very cheap because it is trading at really low levels. Price to free cash flow is still expensive because free cash flow numbers have come down significantly, but everything else on a price to cash, price to operating income, price to gross profit, enterprise value to EBITDA, enterprise value to sales, price to book, everything else trading at pretty cheap valuations relative to its own average. So again, this is a company that, again, is not doing super well in terms of growth or anything else for that matter. So if you come over to the quarterly numbers, so these are yet to be updated. Hopefully they will be updated by tomorrow from our data provider. And then you can also take a look at, today's earnings that Walgreens just reported. But this right here is as of the last numbers on February 29th, huge net loss. And this right here, our earnings before tax is also over $13 billion in net losses as well for the company. So coming in very, very strongly down for the business as well. So if you come over to the cash flow, again, you'll notice negative 12.3 $3.22 billion in net loss for the company. And this is, again, going to be the negative free cash flow. Free cash flow of $557 million as of the last quarter as well. And again, you can kind of visualize these numbers on an annual basis as well. So if you want to take a look, you can look at it from a 10-year to as much as 20-year worth of analysis for any stock. So they were growing, right? So 2015 pretty much kind of marked, the top in terms of gross profit of almost 30 billion. And then we can also plot revenue. So let's just include for revenue as well. So revenue did increase as much as in 2020. So they obviously did increase in revenue, but profitability continued to be somewhat flat to slightly down. So it clearly shows that the business decisions that the company made after 2015 were not that great, because the highest gross profit for the company was, in 2018, 30.8 billion. 29 billion, and this was 29.8 billion. So 30.8 billion was back in 2018, and since then they haven't really been able to, go above that level, even though revenue topped in 2020 at almost 140 billion dollars. So if you remove for revenue here now, and let's just take a look at gross profit, topped in 2018, and then if you take a look at operating income, so let's just remove for gross profit, now if you look at operating income, or EBITDA for that matter, again topped in 2018 at around 8.6 billion, and since then it's just been going down. It's just been declining quite rapidly. And then finally, operating income, or this is EBITDA again. So if you remove for that, now we're looking at operating income and free cash flows. They both topped in around 2018. 2018 really marked the year profitability wise, where the company kind of topped out. Revenue wise, topped out also in 2018. But then again, gross profit wise, it topped out in 2015. And of course, since then, it's just been on a steady decline in terms of fundamentals. And again, business fundamentals, they decline slower than the price action itself. The markets are a little bit more forward looking and forward thinking in a way that, okay, they can capture a lot of things prior to the changes in the business fundamentals. So that obviously what ended up happening here for the company over time. So coming over to analyst estimates. So we've got a hold rating, 26 ratings with a low target of about $13. And right now, of course, it's trading at $11.76, so it's already below the low target of $13. We got an average target of 22, high target of 36. I'm sure these are going to change. There's going to be a lot of new estimates coming out for Walgreens, and the CAGR for the company, you'll notice it's expected to go from about $3.25, which has been revised down significantly, as you can see, that the company is now guiding for. If you come back up, it's guiding for about $2.80 to as much as $2.95. So this is also going to update on our platform by tomorrow, once our data provider updates this. And then again, over the long-term forecast is also going to come down. So these are obviously going to not be great numbers. And revenue-wise, $139 billion, expected to go to $172 by 2028. That's going to be a 4.3% CAGR. But given the company's fundamentals, given the positioning and everything else, I doubt that's going to happen. So if you come over to the Analyzer tab, there's not really much we can do because last year's net income was a net loss. In terms of discounted cash flow, $142 million with the last 5 years, or even 3 years or 7 years have been negative. In other words, they've been going down in terms of free cash flow growth. So there's not really much we can do in terms of that intrinsic value for Walgreens. So this is a company that, unfortunately was already showing signs of, failure. And we kind of, originally when I invested in the company, I remember I did it for the whole sake of dividends, right? Dividends was one of the reasons why I was so attracted towards Walgreens, because it was a very nice dividend aristocrat. They haven't really missed out any dividend payouts. They've been very, very consistent, but of course we had the dividend cut. And then the company's transition into something that's more of a healthcare company, pharmaceutical, didn't really happen. Didn't really, there's poor execution across the board. And for that reason, the company wasn't able to turn things around. Then we had the resignation from the past CEO. Then, of course, a new CEO was appointed. And they're going to now start saving some overhead cost. And they really need to cut down on a lot of costs to make the business more lean and more sort of focused on profitability and free cash flow. And that, I think, is really where the focus needs to be for the company, but also paying down debt so that they become more and more lean and more efficient over the long term. But that's where we are. I mean, Walgreens, unfortunately, as much as lucrative as a dividend is, again, it still doesn't justify for the price action. Of course, the fact that it's selling off so aggressively. And, we're already blown past the support of around 1336. Feels like very much of a free-falling knife, unfortunately, and it's now coming back to the same levels from back in 1998. So it's, that's kind of sad that this is a company that's now trading back to its levels from 1998. So if you do the math here, that is going to be a low from 26 years ago, a 26-year low. So if anybody's holding Walgreens from 1998 up until now, 26 years later, they've literally made zero money. I mean, they've gotten dividends, so that's it. But in terms of the capital appreciation, absolutely nothing. So quite crazy. But let me know your thoughts down in the comment section below. Unfortunately, Walgreens not investable at this moment. If there's any type of turnaround story, we'll keep a close eye. But I agree. I made a mistake with Walgreens, and I took that mistake and realized it into a small loss after accounting for dividends, which I can, again, better allocate capital over to other stocks and, of course, make back some of those losses. So I hope you all enjoyed this video. And let me know your thoughts down in the comment section below. And again, subscribe to the channel if you want access to the entire platform where you can do your own analysis, own fundamental research on individual companies and stocks. Link's going to be down below. We're going to be launching this on July 8th. We'd love to have you on board. And as always, happy investing. I'll see you all in the next video.